Welcome to the B.F. Anderson Technical Report for March 25th. It's been a difficult week so far. We are in a bear market. You know, the book, I always recommend books, and the book that I'm recommending that everyone take a look at is by Gerald Loeb, and it's all about the battle for investment survival. And, you know, Loeb wrote this book in 1936 after the Great Depression. Interesting period of time, and basically what his message is that you've got to have strategies with your portfolio that when it becomes time to, protect the money, he is real big on that subject, meaning you've got to have it's a battle just to survive, but you've got to survive so that when the good times do come, you're there and you have the capital to take advantage of it. All right, on the NASDAQ, we're continuing to see, we pulled back. We're looking like we're trying to put in some type of base here. However, these moving averages are still turning down, so it's telling you to continue to be cautious. Don't try to be a hero. Do a little bit of nibbling if you feel it's the right thing to do. Start out with half of what you normally would do type of thing. In other words, if you buy 100 shares, maybe you should buy 50 shares. On the weekly graph, here we have the 35-week moving average, which is now turning down. We are now in the third week below the moving average. We're going to look at something later in the video on this. The global Dow, the main thing about the global Dow, and you can't help but notice this, but the MACD, which is the moving average convergence divergence, which is measuring momentum, you can't help but noticing the tremendous amount of downward momentum here, pretty much higher than anything we've seen in quite a while, even if you go back to 16, which was going into the election. Been a very catastrophic drop for the global stocks. Now, the small cap, same story. Big MACD sell-off. The index is way down. Again, this is just telling you to be cautious. Here's the S&P 500. Same thing. You got a big drop-off in momentum. This will change. This will flip the other way, but just not yet. Here's the value line geometric, which is a very broad index. We're seeing a lot of downward momentum as we speak. Here's China. Now, this is interesting. China is holding up better than most markets right now. If you remember the global Dow, you had massive sell-off in momentum. You've already had that with China, during the trade war and the trade talks. And then now we're starting to see momentum shifting. Be open-minded at looking at Chinese companies. It is possible that their economy at some point will be larger than ours. More than likely will be. Okay, this is the aggression index. The lower moving average is the 40-week moving average. That's a critical level that it held, and so we're seeing a little bit of an improvement on the aggression index. People kind of becoming a little aggressive here. Now, the three economic indicators that we're looking at, this is the Treasury yield on the 10-year Treasury note. That's 0.85. Actually, today, the yield on the 90-day Treasury bill and the 1-week Treasury bill actually went negative. Oil continues to stay in the tank. Small caps, small rally, nothing to write home about. On the put-call ratio, we are seeing a lot of fear. This is a real big positive because this is how market bottoms are made, in periods of very high fear. So we're in extreme fear here, just like we were in extreme greed here when the market was at a top. So what I'm just saying is you probably should be having a watch list, which we'll talk a little bit more about, but you should have a watch list at this point. Now, as we look for the market to stabilize and form a base, we want to see like a drop and then like a floor or a cup or a U or something like that, or a W. Hopefully it's not an L. You don't want that. Okay, here's the 200-day moving average. We would like to see the S&P get back above its 200-day. Just not there yet. It's just not right. Okay, I wanted to make note of this. This is the 35-week moving average. Each dot on this page represents a week. The rule is 2 weeks below that line is a sell signal. But what's really interesting here is look how deep this particular week, which was last week, got down to. I mean, this is the lowest reading we've seen, which was back in the bear market of 2018. But look how deep that reading is. But also notice that the NASDAQ is not as deep. Now, who's to say that we don't get that deep? But the NASDAQ is holding up, meaning technology stocks primarily, are holding up much better than the S&P 500. Now, I wanted to show something here that I thought was important. If you choose to nibble and look at ideas, I have here a graph that shows the 10-day moving average, the 25-day moving average, the 50-day moving average, and the 200-day moving average. As you can see, as of today, we're back above the 10-day. That's a good sign. It could be a reason to consider nibbling, but let's go to the next graph. This is the New York Composite. The first graph, by the way, was the mid-cap stocks. This is the big New York Stock Exchange stocks. Again, up above that 10-day moving average. That's good. Here's the small cap stocks, which we're very in tune with. It too has broken above the 10-day moving average. This could be the beginning, but really, really early. Here's the NASDAQ. You can see here it as well. It actually yesterday broke above the 10-day moving average and continued to hold it today. So just be aware of this. Now on the S&P 500, again above the 10-day moving average. So we're starting to see the process of a bottom. Bottoms are never going to be a single point in time. It's going to really be a process that you have to go through. And if you have questions on that, feel free to give me a call. Wanted to hit one thing here. This is oil. This is the 10-20 moving averages, the 10-month versus the 20-month. And look how valuable this has been, because back in 2014, we got the death cross in oil stocks, at roughly $100 a share, $95 a barrel. So we pretty much have been warning people since 2014 to avoid the oil stocks, and it's been nothing but bad ever since. So you can see this is where oil is now. We're back on a death cross again. I don't know if oil is going to be able to rally, but it certainly is in a bear market. All right, this is another graph I wanted to kind of hit on real quick. This is the high yield corporate bond fund. This is junk bonds, all right? Look at what's happened here. Usually when you get into a bad stock market, everybody runs to bonds. Well, in this case, you can see, the bond market has been taking a tremendous hit too. This is not a positive sign. We really need to see an improvement in these bonds. Now, real quick on the top 5. This is a pharmaceutical, Moderna. Not ready to buy yet. We really don't have a volume signature on it. Too volatile. This is Regeneron Pharmaceuticals. Nah, not really doing a whole lot. This is TAL Education. Now, this is interesting. This is China. This is a company that educates the Chinese people, mainly learning how to speak English. They want to be like us, all right? So basically, you can see here it has broken out above the 50-day moving average. Keep an eye on it. This is Teladoc, kind of broke down today. We had what you call a gap up buy signal. The stock broke down below the gap. We actually own the stock. We have now sold the stock. Tesla, again, continues to act okay. Looks like maybe a little bit of a V bottom here. And just don't forget, in April, they've got their battery day coming up. We could hear some big announcements. We certainly want to keep an eye on Tesla. We are just not on a buy signal at this point. So, if you have any questions, give me a call. Sorry about how long the video was, but we had a lot to cover. Thank you.